Hello, everyone. Today on the final bar, my guest is Dana Lyons, joining us to talk about a number of different topics, big picture themes, looking at commodities, looking at growth versus value. Today, looking at the markets, it was either a great day if you're looking at the Dow, an okay choppy day if you're looking at the S&P, or a down day if you're looking at the NASDAQ. And this sort of spread between those three, I think, really tells the story of a market in transition. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of charts, the power of the visualization of market psychology, of investor behavior, of the fear and the greed, the supply and demand that causes prices to evolve in the form of trends. As Charles Dow told us over 100 years ago, the market moves in trends. And by looking at those trends, you can understand the direction of the economy. And that's to this day what we're still doing, even though our toolkit has improved our ability to analyze things more quickly with greater information, access to information than ever before for individual investors, for sure. It's still some of the same tried and true trend following discipline that many of us are using. And, you know, it's interesting as we have so many potential headwinds and tailwinds, as always, I'd remind you, looking at the charts, if you're going to do one thing, hopefully you do many things, but if you're going to do just one thing, I hope you start with something involving visualizing price data over time, because I can tell you a lot about all the other stuff. All the other stuff tends to look a lot more clear in the rearview mirror. Having said that, we have a lot of guests along this ride with us, helping us make sense of things. Today, we have Dana Lyons, who's editor of the Lyons Share Report, partner at J Lyons Fund Management, is going to be joining us in a little bit, sharing with you some of his charts that he's paying attention to as he looks at the markets. Tomorrow, on Thursday, we have Willie Delwich from All Star Charts. Next week, on Tuesday, the 16th, we have Jason Geffert from Sentiment Trader. On Wednesday, the 17th, Craig Johnson, the technical analyst at Piper Jaffray in Minneapolis. As a reminder, I was just talking to my friend Greg Schnell earlier today. We were scheming about how to go about our Chart Madness special, which is coming up on March 22nd. We are putting together a bracket of 16 stocks. Greg and I, along with Tom Boley and Grayson Rose, are going to be picking our picks out of all of those matchups, combining our inputs to come up with a final four and a proposed champion of the crowning the top of the brackets for technical analysis based on the charts, and a bunch of other things we'll throw in there as well. That's coming up on March 22nd. So look for that. Let's continue on with our market recap. As I mentioned, this day was, good, okay, or not so good, depending on what chart you were looking at, right? And what your benchmark is, what your main thing. If you're looking at small caps, we were up over 2% today. It was a pretty decent day. A continued follow through day with sectors like energy and materials, which were sort of overrepresented in the small cap index versus others, versus, the S&P doing just fine. The NASDAQ 100 down 1/3% on the same day. So we have this continued rotation away from the growthy stuff into more of the value-y stuff. To summarize, we're going to look at a series of charts that sort of make that case and explain what's going on. Let's check in on some of the other markets very quickly before we do that, though. Looking at other asset classes, bond prices up just a skosh. That was so the TLT was down in the morning and finished up higher. This is pushing 10-year yields back down toward the 1.5% mark. Oil prices continue higher, gold, precious metals continuing higher, copper sort of flat. So for the most part, commodities continuing their long-term uptrend, I would argue. Cryptocurrencies pretty choppy, as always. Bitcoin finishing in the positive, but most of the other top 10 that we follow by market cap actually finished in the red. So continued choppiness there. I want to start with just a short-term chart looking at the last 5 days. And we have the Dow in purple, we have the S&P in black, and we have the NASDAQ in pink at the bottom. And you can see what happened today, right? This is starting about a week ago. And again, it's showing you the percent changes from the starting point to where we're at. The percent changes are less what I'm curious about, and more just to show the direction on a couple of days. If you look at yesterday, sort of everything up, right? NASDAQ bouncing up pretty good. This is when, a lot of growthy technology funds had one of their best days, some of their best days ever. When you have the NASDAQ turning up, from a relative weak point to a quick turn to the left and bouncing to a new swing high. And you can see that all three of these were up together. That's sort of what a normal market usually feels like, where you have these three indexes up together, and it's just which group is leading, right? So you had them all down last Wednesday, all up last Thursday. But look at what happened on Friday, right? You had this big dispersion. You had the Dow up on the day, the S&P a little bit down, and the NASDAQ a lot down. You had kind of a similar thing today. The S&P sort of a little bit up, the Dow a lot up, and the NASDAQ a little bit down. So this illustration is where there's a disconnection between those indexes, right? The exposure that these different indexes have. If you have exposure to technology, you're struggling overall. If you have exposure to energy and financials and those things that have been leadership and industrials, you're doing just fine. And the S&P sort of caught in the middle, right? And so, depending on what you think about what your portfolio looks like, if your portfolio is very growth oriented, some of these days are going to feel a lot more painful than if it's more conservative, if it's more not necessarily conservative, but more leaning into the leadership of the recent months, right? That's what's continuing to work. So your portfolio could look very different depending on what sort of bets you have and how you're allocated right about now. So it is not just, I would argue, an equity decision, am I in or out of equities? Where you're at, what bets you're making are certainly giving you a very different return profile right now. Let's look at the S&P 500. So as we've talked about, I think we're still very much in a market in transition. It's been a nice bounce of a couple of days. There's no denying that. Yesterday, we traded up to this trend line using the recent swing highs. This is pretty short term, looking at the peaks from the last couple of weeks. We closed above that today. So now I think we're testing this swing high sort of from the end of February, beginning of March. That's sort of where we're at, just above 3,900, call it 3,925 or so. Getting back above there, getting back above the previous highs. That would tell me to not be as negative as I've probably been feeling right now. But overall, I still feel the weakness in technology has more to go, and it's hard for me to think of the market going up materially with things like semiconductors struggling, as they certainly are again today. But having said that, again, focus on the message of the chart itself. It's now, testing its previous swing high, breaking above trend line. That's certainly a thumbs up. Testing a previous swing high is good. If it's able to do that, it's not just the S&P that's doing better, but it's a lot of individual stocks. And when I'm looking at random stock, looking at energy stocks and others, Viacom and others, these are stocks that are continuing to go to new highs. Not worried about the market, quote unquote, what the market is doing. They're just in uptrends, and in general, following uptrends and leaning into uptrends and leaning away from downtrends is the general discipline that we've been talking about here. So, if we get materially higher than here, and for me, I think as long as we remain above that mid-February high, I still think it's safe to assume there's more backing and filling that needs to happen. Long term, I would argue, I certainly think we have much higher that we could go for the equity markets, but I would be amazed and certainly caught off guard if we would materially go much higher than this. It's a question of if we go a little bit higher or a lot lower, in my opinion. And there's enough of a risk of a lot lower that I want to be paying attention to lines in the sand. If and when we do turn back over, which again, I would not be surprised to see, we have broken all of those or checked off all of the boxes except a close below the January low around 3,700. Once that happens, I think you will find a lot more selling that potentially enters it, because that's an indication that the market is rolling to a new swing low, really getting below some of these previous lows, and then it's making a lower high and a lower low, and that's a confirmed downtrend. Right now, we're sort of in a holding pattern. It's about what it feels like. Again, depending on what chart you look at, things look pretty good, or they look pretty challenged. Let's see. Next chart I wanted to show you is just a chart of semiconductors. When we talk about the weakness in some of these technology spaces, semis closed down about 2% today, so it's not the end of the world. And again, this chart is not horribly broken yet, so please don't assume that that's what I'm suggesting here. But for me, I feel like months, if not years from now, when you look back at this period and you look for tells in the market, the bearish divergence in semiconductors may be the most obvious. And as I've mentioned before, I think this either works beautifully and you get this incredible validation for an indication of exhaustion of buyers, which is what we saw here in December, January, February, going into the February 2020 high. We're seeing a similar pattern here with the market moving to a new high, but the momentum coming out of it. Or this fails and semiconductors go to a new high, and it's an indication that the euphoria is not dissipated yet. There is enough optimism still in equities to push this sort of this group higher. The fact that we've broken down through the January low, and I think that's important to know. The S&P has not; it's held above it. But if you look at the Nasdaq, if you look at semiconductors, you're finding indexes and stocks that are breaking below their swing lows. The FANG stocks would be the other group to watch them. They either have done that or they're right about bouncing around those levels where you're getting a valid breakdown indicating at least an increased risk of further downside potential. So semiconductors, I think, are a really important group to watch. At this point, they have bounced off for a little bit, bounced so far off of the RSI 40 level. That is still could be arguably a bull market thing. The fact that it's broken down through the 50-day and broken down through the January low, though, I think tells me the path of least resistance is down. We'll have to see what happens next, but I think that's a very important chart to watch. Just to finish off very quickly, and then we need to take a quick break. In terms of what worked today, you'll see a lot of industrials in the top group. Home construction, this would be things like home builders, also things like Home Depot and Lowe's would be related to that in some ways. Aerospace as well. So if you look at the chart of Boeing, and again, having moved to the Seattle area, Boeing is one of those charts I tend to refer to. A nice little breakout. These are stocks in these sectors are breaking above some key resistance levels worth paying attention to. But then with all of that industrials and everything, gambling stocks in the top 10 as well. So as always, I would pay attention less to what should work and focus on what is working. Let's take a quick commercial break. Back with my guest, Dana Lyons. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we review the charts of interest every weekday. As a reminder, we love to hear from you. We'll do another mailbag segment on Friday's show. We'd love to answer one of your questions on the air. You can get your questions to us three ways. One is via email, thefinalbar@stockcharts.com. Second, on Twitter @FinalBarSCTV, or on our YouTube channel, just put a comment right below the video that you're watching. We'd love to answer one of your questions in Friday's mailbag segment. Also, as a reminder, the new StockCharts TV on demand is out and available for you everywhere. Go to stockchartstv.com, set up a free account with your email, and you can immediately start watching all of the content from our great suite of hosts and guests. Also, you can go to all of the app stores, Apple, Amazon, Roku, wherever it is. You will find the StockCharts TV app, again, free to download, install, put in your email, and you're off and running. I want to welcome on my guest, Dana Lyons, back to the show. Dana's the editor of the Lyons Share Report, also a partner at J Lyons Fund Management. Dana, welcome back to the show.
Thanks, Dave. Great to be back.
So, I feel like for many of us just dealing with, uncertain times for a while now, but certainly a market that's felt more volatile and more uncertain, certainly a transition of sorts in place. Love to get your take on the big picture, starting with gold, looking at precious metals, which have had obviously a pretty significant pullback. Where are you at with gold now?
Yeah, our take on basically the whole precious metals complex is that we had a huge rally up into the summer of last year. And we tested the highs from 2011, whether you're talking about GLD or gold. And our thought was we needed to cool off, consolidate, kind of refuel up for a potential breakout, so it could be a sustainable breakout. So what we've seen in our view since last summer is just a consolidation, a little pullback, and we've been looking for entry points back into it. What we like to see is a confluence or a cluster of strong support levels. So what we saw a couple days ago was whether it's gold or GLD, we saw a cluster of key Fibonacci retracement levels. So the 38 retracement from the 2015 low, and then the 61 retracement from the March low of last year, basically line up around that 158 level. So we bought back our gold a couple days ago, and like to see this area hold and start that next up leg.
It's interesting, and going to the second chart, it's a similar pattern of sorts to EM, right? Emerging markets, a little different because it broke above its 18 high there. You can see on the chart, but are you seeing a similar pattern here?
Similar in the sense that we're seeing a confluence of good support levels. So we saw EM and emerging markets, power off of those pre-election lows, like a lot of areas, went right to new highs, which we don't like to see. If it does that, it's usually not sustained right away. And indeed, what we're seeing now is a retracement back towards that breakout level of the highs from 2018, which also again line up with that 23 retracement from the March low, as well as a 38 retracement from the September low, right in this general vicinity right here. So probably a good entry point into EEM.
Now, your next chart, obviously, we've talked about a market in transition. I feel like I've said that phrase a number of times. And today, for example, right, you have energy financials at the top of the list. You have technology down on the same day. Give us your long-term perspective, growth versus value.
Yeah, absolutely. And this is a chart that we've been looking at for a long time, waiting for value to reassert itself, but it's been a long time coming. We've had lots of fits and starts. This one's a little bit more convincing. So in the top panel, you see the ratio of growth to value turning down. We've had some head fakes along the way, though. This one more convincing, perhaps, as we measure the actual outperformance by value versus growth. If you measure it over a 3-week period, just a few days ago, it reached a outperformance in value by over 12%, which we've only seen one other time, and that was back in the 2001 major transition into value from growth after the dot-com bubble. And that a period of outperformance for value lasted, into near that 2006 top, so lasted for a number of years. So it won't be straight up, but maybe a sign that we're seeing some sort of a transition like that.
And it's interesting. My technician hat, which I pretty much always have on, is when you see something that's gone this far, right, this much of a change, you immediately feel like you'd expect some sort of snapback or something, right? Think of a stock that's oversold, but what you're showing here is after the tech bubble, right? If you start in 2000, from there, that sort of big change to outperformance of value was just the beginning of that trend, right? That lasted for years afterwards, right?
That's right. It was kind of a shock, if you will, that ignited that major transition. Like you said, there's going to be stops and starts along the way, but this type of a major shock is often seen in like a major transition, a major top or bottom.
Now we have time for just one more here, Dana, and I love this chart looking at basically, I would describe it as indecision, right? You have stocks making new highs and new lows recently. What is this telling you?
Yeah, like we've seen, it's similar to that Hindenburg omen, but we've seen recently a number of new highs and new lows, both on the NYSE and the Nasdaq, reaching very high levels. And we've seen in the past when that's occurred near 52-week highs in the S&P 500, it has been a signal of maybe indecision or perhaps some creeping underlying weakness under the surface that maybe is being masked by the index, and just a sign of elevated risk. I would say there is one caveat to this, is the fact that there's been such a proliferation of new offerings, the SPACs and whatnot, that may be inflating the number of new lows. But on the surface level, it is one of the first maybe red flags that we've noticed since the start of the rally around the election time.
Dana, as always, it's so good to have you on. I love your long-term perspective. You have such a calmness of looking at these markets when I feel like it's a dose of calm that most people need. Thanks so much for coming on the show. Hope you stay safe, those around you as well, and we'll talk to you again soon. All right.
Always a pleasure. Thanks, Dave.
That's Dana Lyons. Dana's the editor of the Lyons Share Report, also partner at J Lyons Fund Management. And again, I hope you got what I took away from that. It's such a pleasure to talk with someone like Dana, who's sort of going through his big picture perspective and illustrating how you make sense of choppy moves like this. With huge pullbacks in gold and gold stocks with mean reversion with a big rotation. In the end, the best thing you can do is look at the longer term perspective, try to put things in proper context, understand how these themes don't just evolve minute to minute, they evolve month and month, year over year. And so make sure you have the appropriate time frame in mind. That's a great take there. Let's continue on the show. Our next segment is called ETFs Engage. What we love to do occasionally is just bring up an ETF or a group of ETFs, and talk about some of the structures of them, how to think about them, is try to help educate ourselves about the risks and the opportunities of looking at different ETFs. I find the opportunity that ETFs provide is certainly unprecedented in terms of the markets and the asset classes that you have access to as an individual investor, as an advisor now, that would have been much more difficult or much more expensive to do in years and in decades past. Having said that, though, there's also a lot of detail in terms of how these things are constructed, what sort of exposures you have. I find a lot of times people have get ETFs and don't really have an awareness or understand not just expenses and things like that, price spreads, but also just the exposure that you get and what bets you're actually making. And a lot of times unintended consequences can bubble up. And what we're going to do today, we've talked about other ETFs, talked about home builder ETFs, China ETFs. I remember talking about, we've talked about a number of different ones. Today, I actually want to focus on the ARK Innovation ETF. This is obviously something that's been in the news, Kathy Wood, and talking about her her perspective, looking at transformative businesses, and certainly has been widely covered. What I want to do is focus a little more on two things. Number one, that from a technical perspective, what can the charts tell us about the prospects for an ETF like this, but also just some of the nuts and bolts underneath it. What you should be aware of thinking about this ETF and what the potential implications might be. As always, let's start with the charts. There are a couple different ARK ETFs. We're looking at ARKK, which is the ARK Innovation ETF. It's the most commonly referred to one. And we're looking at sort of the standard Dave Keller chart, the price, relative strength, the RSI, second, and then relative strength, the ARK versus the S&P at the bottom. Now, what you can obviously see is this ETF has had an incredible run. And if you look at the relative performance at the bottom, starting the clock at the March lows, this has just been a fantastic run of performance. And if you look at what sort of bets are being made, it's a lot of those work from home stocks that have had fantastic runs, stocks like Zoom and Peloton, and payment processors like a PayPal, clean energy names. These are all the ones that are sort of that are represented here, or overweighted here versus the S&P. And as that type of name has worked, it's done very, very well. What's happened though in the last 2 to 3 weeks is it's given back a lot of those gains. And the ARK ETF, ARK Innovation ETF, has gone down from 160 to bottom out around 106 a couple of days ago. So since bounced up a couple points here, we're just above 121, came off about 0.5% today. So, from a technical perspective, well, what can we see? Well, so what's interesting is this ETF has become oversold. The only other couple times it's been oversold, back here at the bottom in March 2020, you can go back to October of 2019, June of 2019. What is the common thread with all of those other times? It's gone up pretty well after that, right? I mean, the run over the next 6 to 8 weeks has been consistently positive if you look at the last couple of years. So the question, as always, right, is this time different? Is this a larger unwind out of the growth trade and into other things, value trade and others that would be underrepresented in an ETF like this? And I think that's the very real risk that you're seeing. So when people see it's oversold and they think, all right, this could be about a good potential bounce opportunity, I'm not surprised to see the ETF bounce higher this week. You can also use a Fibonacci retracement. Saw that Dana Lyons did a great job of illustrating some of the long-term uses of Fibonacci. He and I, clearly use Fibonacci retracements in a very similar way, which is looking at long-term trends and just trying to get some lines in the sand at what is a reasonable pullback and where you have to start to get concerned about potential for further downside. So not surprising that this bounced down to the 38.2% retracement level of the March 2020 low to the February 2021 high. That makes a lot of sense. We've retraced about 38.2% of the way. Not surprisingly, this looks like a lot of the stocks that are in here, Zoom and others that have had a very similar trajectory. Really nice run, nice relative performance run. And then they've given back about a third of the way, about 38.2% of the way. The danger here, or the challenge, is what is the probability that it goes back below and closes below this Fibonacci support level and what's next. So I would argue, right, the 200-day moving average is always an important one to watch. I would be looking there, which is just above 100. Big round numbers tend to be important. So a cluster around $100 is always an important one to pay attention to. But I'd be looking a little further down to the 61.8% retracement level, which would be the September low. It's sort of after the March 2020 bottom, after the run. This is where it spent about 3 months or so, sort of a consolidation range before the market moved to new highs in November, and the ARK Innovation Fund started to outperform once again. So the challenge with a chart like this is if support does not hold, if this gets below 110, which would be the level I would pencil in and be watching, then there's a real risk or an increased probability that it goes down and tests something further. And the problem is, what does the market look like? What does the NASDAQ look like? What do those individual stocks look like if this goes down another 30 points? And again, it is not an absolute certainty by any means. I think investing and technical analysis is all about probabilities. What I would say is if it breaks 110, you have to think about the increased probability of further downside. So from a technical perspective, I think that's how I would be looking at an ETF like this. What's interesting about it is and a couple of things just talking about structure and how to think of it. One of the challenges with an ETF like this and with hearing a lot of Kathy Wood's interviews and what she's doing, the assets have grown significantly. So it's probably, actually I haven't looked recently. I want to say it's like 20 to 25 billion probably in assets. It peaked out just below 30 billion a couple weeks ago and has come back with a lot of the downside in the performance. But overall, it's gained a ton of assets. That's 10 times what it was a year ago probably. And so the challenge is, I know just from working with fund managers running larger groups of assets, the challenge is, where do you put it? You can't put all of those assets into one stock. There's just not enough room. And so you have to start spreading it out. And what they've done with this ETF is buy some of the FANG stocks, right? Buy things like Facebook and Apple and others just to park the assets. Those aren't really innovative necessarily companies, but they're big enough that they can handle a lot of assets. And then when the market goes down, you sell some of those and keep your risky bets on. So the challenge for that is that works as long as the market overall holds up. If the market turns lower and you have more redemptions in an ETF like this, you're forced to sell some of those positions to accommodate the redemptions, and that unfortunately can cause a feedback loop of a downtrend. And again, I don't know if that's going to happen, but I do know that the further the price goes down, the more and more of a risk that is. And again, that's based on if people start selling the ETF, you have to account for that. This sort of ETF, I would also say, you categorize it as growth and definitely as offense. So you are, an ETF like this, you are betting on growth and offense. You're betting on the market going higher and the growth trade working. So if that's not what you think is going to happen, this is certainly not an ideal vehicle to be expressing your bets. If you do think so, and again, a lot of people look at an ETF like this and wonder why it's not, there's not a more defensive positioning if the market goes down. But that's not the style of this sort of fund. So that was a quick rundown. Again, I've been talking to a number of my peers about the implications of the ARK Innovation ETF going down and what that means for flows and other things. I wanted to give you a little bit of a rundown with that. And again, from a technical perspective, 110, which was the closing low from earlier this week, is the line I'd be looking at. We need to wrap this show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the Bullish Percent Index. This is an overall measure of breadth based on point and figure charts. At this point, 66% of the S&P are in a buy signal according to the point and figure charts, which means 1 out of 3 is still in a sell signal. If and when the market would go higher and there are less and less stocks making a buy signal from their point and figure chart, that's less ideal. And that's what we've been seeing over the last couple months, continues to this day. Chart number 2 is energy. I mentioned talking with Greg Schnell earlier. When I talk with Greg, we end up going through energy stocks. By default, he always, he knows more about energy stocks than I could ever hope to, and it's always fascinating. What we were talking about is just the run that they've had seems extreme, but if you look at the long-term trend in these stocks, you're still just back to where you were in 2019. There could be plenty of upside potential. What concerns me in the short term, not what concern, but something to look for, is that it's overbought. That's happened on the weekly chart. It's happened 3 other times in the last 7 years. Every one of those times we've pulled back afterwards. Number 3, one of the top ranked mid-cap scooter stocks is TPL, a name a lot of us probably do not know. There's an example of the upside potential in some of those names. That's our show, folks. I want to thank Dana Lyons for joining us today, sharing his perspective for sure. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.